When you think about a recession, there's an automatic assumption that this is something inherently bad. But recessions are a natural occurrence in any market-based economy, and they serve a purpose that's needed to keep the economy healthy long term. But before we get into that, we have to understand the conditions that occur before every recession because they all follow a very similar pattern. The first stage of every recession starts with central banks keeping extremely low interest rates. Sometimes it's to fix a previous recession, sometimes it's to stimulate growth, but either way, that part doesn't really matter. What matters is what happens next. Because when interest rates are low, credit gets cheap and banks start lending aggressively, and people start borrowing more money for everything. Before the 2008 housing crash, the Federal Reserve cut rates from about 6.5% all the way down to 1%. But cheap money doesn't just sit there. It flows into the economy and it changes behavior. People start to take on more debt, and we really saw this in full effect when household debt as a percentage of disposable income went from around 77% in 1990 to about 127% by 2007. That's not a small increase. That's people fundamentally changing how they live, using debt to support their lifestyle. Then, with all that cheap money, people start buying houses that they could barely afford. And by 2006, home prices were about 4.6 times household income. And companies do the exact same thing. They borrow from banks to grow fast, and investment banks at the time were running 30-to-1 leverage. That means for every dollar they owed, they were borrowing 30 more to amplify their bets. And on the surface, everything looks great. GDP is growing, unemployment is low, and stocks are going up. But underneath all of it, it's just debt. It's not real wealth. And economists have a term for this called malinvestment. It's when artificially low interest rates trick businesses into thinking there's more demand and saving than actually exists. So they invest in projects that only make sense if money stays cheap forever. So the boom isn't real. It's inflated by credit expansion, and the longer it goes on, the bigger the correction has to be when it finally ends. Now here's the thing about cheap credit. People and businesses don't use it to increase wages. They use it to buy assets. Things like stocks, crypto, real estate, or expanding operations. And the reason is because when you can borrow money at 1% or 2%, you're not using that money to buy groceries. You're using it to buy things you think are going to go up in value. That's how you make money off of cheap debt. And we've seen this play out over and over again. During the 2000s housing bubble, nearly 40% of homes bought in 2005 and 2006 were investment properties or vacation homes, not primary residences. People weren't buying homes to live in, they were buying them to flip or rent out. In the dot-com boom, it was the same thing. Tech companies with zero earnings were going public at billion-dollar valuations. Companies like Pets.com, Webvan, these businesses had never made a profit and they never would. So when all of this cheap money starts flowing into assets, asset prices start exploding upwards. And regular people working normal jobs who aren't speculating, they start feeling poorer because their wages aren't keeping up with asset prices. If you want to buy a house, now it costs 5 times your income instead of 3. If you want to invest in the stock market, valuations are already at record highs. This is called the bubble phase, and it always comes with the same language. Homes always go up. This technology is different, and it's impossible to lose. And that type of language, that absolute confidence that this new thing could never fall in price, is always the top of the bubble. And eventually, all that newly created money starts causing a major problem that gets talked about on the news almost every single day: inflation. Because when there's massive amounts of debt being borrowed and getting spent, it reacts the same way as new money being poured into the system. And when there's more money chasing the same amount of stuff, prices start going up. And once inflation gets too high, the central bank doesn't really have a choice anymore. They have to raise interest rates. Between 2004 and 2006, the Federal Reserve raised rates 17 times, from 1% all the way to 5.25%. That's over a 4-point increase in just 2 years, because they were trying to cool down the housing market and get inflation under control. And once interest rates start rising, everything starts to break because all that debt people took on when money was cheap, it suddenly becomes way more expensive. Once adjustable rate mortgages started to reset higher, people who could barely afford their payments at 3% are now staring at 6% or 7%. And once credit card interest jumps and business loans get more expensive, companies that were planning to refinance their debt suddenly realize they can't afford the new rates. The same debt machine that powered the boom starts choking. And the critical part is that the central bank knows that this is going to hurt. They know raising rates slows the economy, but they have to do it to lower inflation and slow down the bubble, because if they don't, either inflation is going to run rampant, or when the bubble eventually pops, it's going to be much worse. But the problem is, they typically take way too long to start raising rates, so by the time they do start, the system is already so over-leveraged that even small rate increases end up having devastating effects. And one of the best indicators that a recession is coming is to look at the bond market. Normally, when you lend money for longer periods of time, you expect to get paid more. Lending for 10 years should pay more than lending for 3 years because you're taking on more risk. That's just common sense. But when people start getting scared about the economy, they stop thinking about returns and they start thinking about safety. So instead of putting money into stocks or risky investments, investors put all of their money into long-term government bonds. They basically say, I don't really care about making money, I just don't want to lose it. And that massive flow of money into long-term bonds pushes bond prices up. And because prices and yields, or the interest you're getting on your money, move in opposite directions, long-term yield returns on bonds fall. And at the same time, short-term bond rates are still high because the central bank just raised them to fight inflation. So you get this weird situation where short-term rates are higher than long-term rates. It's basically the bond market quietly screaming that a recession is coming, because nobody willingly locks their money away for 10 years at a lower return than if they were to just buy a 3-month bond, unless they're scared of what's coming ahead. So when you see that inversion happen, when the 10-year yield is less than the 2-year or 3-month yield, you know that's a signal that investors are expecting a recession. And then finally, to actually start the recession comes the trigger. And this part is important because it's never actually the cause of the recession. The system was already broken. This is just the moment that everyone finally realizes it. In March 2008, to start the '08 recession, Bear Stearns, one of the biggest Wall Street banks, was basically about to go bankrupt. And just 1 week earlier, its stock was trading around $60 a share. Then the Fed stepped in and helped sell it to JP Morgan for $2 a share. 6 months later, Lehman Brothers collapsed. The government decided not to bail them out, and then the Dow dropped over 500 points in a single day. Then AIG needed an $85 billion bailout. Then money market funds broke the buck, meaning people couldn't get their full cash back, which is supposed to never happen. And investors pulled $144 billion out of money market funds in 1 week. And that's basically a bank run. At the same time, the short-term lending market, the one companies use to make payroll and keep day-to-day operations running, just froze. Because the system was already stretched so thin, one small crack turned into a full collapse. And then we really start to see the full effects of a recession. About 9 million jobs were lost in '08 and '09, and that was roughly 6% of the entire workforce. The stock market collapsed. Credit disappeared. Everything just shuts down. And here's the wild part. The recession officially started in December 2007. That's what the National Bureau of Economic Research later confirmed, which means most people didn't even realize they were already in a recession until almost a year later. So where are we in this cycle right now? Because remember, all market-based economies go through this cycle. It's just a matter of when. So let's start with cheap credit. Interest rates were basically zero from 2008 all the way to 2002. That's 14 years of cheap credit. Next, let's talk about asset bubbles. Housing prices are at all-time highs relative to income. The S&P 500 is near all-time highs, and Bitcoin has had a massive pump recently close to all-time highs. Now here's where it gets interesting. The yield curve inverted back in July of 2022, and it stayed inverted for 783 days straight, the longest inversion in US history. But then it uninverted in September of 2024. And remember what I said earlier, recessions don't usually happen during the inversion, they tend to show up after it uninverts. And since then, unemployment has moved from about 3.7% to 4.6%, the highest level in 4 years. Consumer confidence dropped to recession levels in late 2025, when job growth in Q4 of 2025 was only about 79,000 jobs, roughly 1/5 of the pace of the year before. And manufacturing has also been contracting. So now you've got multiple indicators flashing at the same time. Does that mean that a recession is guaranteed? No. Indicators can be wrong. The economy is different than it was in 2008, and there's massive AI investment happening, and government deficit spending is still huge, even during the expansion. But the pattern is there, and it's the same pattern we've seen before, basically every recession for the past 100 years. So we've been talking a lot about the dangers of a recession, but for the average person, recessions are actually one of the biggest opportunities to build long-term wealth. More millionaires are made during recessions than at almost any other point in the cycle. And the reason is simple. You get massive opportunities to buy assets at huge discounts. Things like homes, stocks, even crypto. Everything people wanted when prices were high suddenly goes on sale. And that's when real wealth gets built. So regardless of when the next recession happens, the most important thing right now is making sure you're not over leveraged. Don't put yourself in a position where higher rates or job losses wipe you out. Try to stay liquid, try to have cash ready. Because when fear is high and everyone else is panicking, that's when you get the chance to buy great assets at bargain prices. And that's how people who actually understand the cycle get ahead.